A very good afternoon, good morning. Welcome to HYCM's workshop with myself, Giles Coughlin, Chief Currency Analyst. Hope everybody's doing well. Eddie, Rick, Warren, great to see you guys. Nahar, welcome. I think this might be your first time. Just as the folks are coming in, just going to go through the disclaimer. Don't forget, as we look at different entries, exits, different currency pairs to be trading, this is all from an educational perspective. So I'm going to be running through the latest market news, explaining what's going on. We're also going to unpack some of that UK CPI inflationary data and show you how we go about making sense of that and the potential trade there is there. And that's what we're going to be doing. So without further ado, let's get stuck into the session. And we're going to look at how to trade the UK CPI meeting. Now, that's not tomorrow, that is today. So just excuse that typo. Now, let's just have a look at what we've got. Now, here I'm using the Financial Source trading terminal. I am an analyst here, so I do a lot of my research with Financial Source, and it's an excellent service, by the way. Now, just taking a look at the CPI data we had that came out very early in the UK session. In fact, I'll just pull it up here. I'll just pull it up in advance. You can see here, coming out first thing here in the UK, the inflation data did surprise to the upside, 5.5% versus 5.4% expected. Maximum was 6.1%. Now, you might think, well, that's high inflation, and the headline figures, UK inflation highest it's been for 30 years. But before we get carried away, there is really nothing to get massively surprised about here, because the Bank of England are expecting inflation to go above 7%. And they're expecting it to go above 7% in April. And there's a specific reason for that. The reason for that is the fact that the energy price cap comes into effect then, and the energy price cap is being increased. Now in the UK, energy prices for some people are increasing by over 50%, okay? And that is a significant rise in energy prices. And of course, energy is one of the key inputs into inflationary pressure and obviously cost of living. So the high inflation today is really not a big surprise. And see what the market is expecting. The market is expecting high inflation because the Bank of England itself is expecting high inflation above 7% in April. So none of this is a surprise at all. Okay, that's why the pound is hasn't really acted on this data. It's just been barely a blink, and that's just simply been because of the fact that this is just exactly what was expected. Okay, pound. The reason the pound US dollar is moving a little bit higher is from that dollar weakness rather than anything to do with the CPI. Right. But with that being said, let me give you a clue and I'll show you what data point is more interesting today. Now that's the Canadian inflation data. Now Canadian inflation data is due out later on today, 3:30 UK time, and it's due to come in at 0.6% for the month on month, 4.8% for the year on year. Now, listen, this is a key thing to expect. When everyone's expecting high inflation is not going to get the market's attention. If you just take a look at some of this data here, I'll show you. Now, just take a look here. Have a look at the inflation expectations. Right, you see here, inflation expectations. Canadian inflation 4.8%, EU 5.1, UK 5.4. So inflation is surging across the world. We know that. So what's the best opportunity? The best opportunity comes from a miss in inflation expectations. It means that central banks won't be having to be so aggressive. So what that means, this is how you go about working it out. See, okay, well look, what's the minimum and maximum expectations? Well, the minimum expectations, now where does this data come from? This comes from the Reuters survey. So Reuters survey a number of economists prior to the event and asked them, what do you expect the reading to be? Now, there'll be a high end and there'll be a low end. So the minimum expectations was the 0.1%. Okay, the maximum was 0.9%, and Reuters sort of say, look, the expectations is it should be about 0.6%. Similarly, for the headline, the minimum was 4.3% for the year on year, 5.1% was the maximum. And you can see, look, 20 people were surveyed, 17 people were surveyed here. So what that tells us is that if it goes outside of the economist's survey, it's notable. It's a surprise. It's a shock. And what we're looking for here, is high inflation a shock? Well, if it's above 5.1 and above 0.9, yes, it will. And we'd like to see some bit of CAD strength because that's what market's expecting. We might see the Bank of Canada have more pressure on to hike interest rates, right? But if we see inflation data drop significantly lower, and this is the best opportunity because high inflation is everywhere. If it comes in below 0.1% and below 4.3%, then we'd expect to see CAD weakness. Why? It takes pressure off the Bank of Canada to hike interest rates. It means the CAD can weaken. Now you might think, okay, so what do you do with that knowledge? You're thinking, well, okay, and now I know anything below 0.1, anything below 4.3 for the year on year should be a good opportunity to short the CAD. Now, which currency pair should I look at? Now, generally speaking, you always want to pair strength against weakness. Remember, one of the key teaching lessons that I have is look to back strength against weakness. You see in this image, I haven't shared this for a while, but you see how, if there's one currency that's going to be strong and there's one currency that's going to be weak, you see in this arm wrestle, who would you expect to win the arm wrestle? Well, of course, you'd expect the large arm to win the arm wrestle. That's exactly what we're doing when we're trading. We're trying to trade a strong currency against a weak currency. So with that mental image in mind, if we see CPI data coming in very weak, what will we expect the CAD to do? Fall sharply. Now, which currency pair is currently strong? It's the Australian dollar. So if US CPI inflation, if Canadian CPI inflation is very weak, we'd expect Aussie CAD longs. Okay, that would be a good scalping trade. And that's not a bad trade to be looking at from a medium-term perspective. So then, okay, let's go and have a little look at the Aussie CAD chart, and then we can start looking at our technical levels, okay? So we just look here, let's look at Aussie CAD. Right. And we start to see, okay, got this key level here, we got this support level got this recent swing point, so you stop to be placed underneath 0.9050, you've got key overhead resistance just up here, and let's have a look here, 100 exponential moving average, just that 0.9140 level. So you think, okay, let's have a look at pivot points. Think, okay, and let's put the second pivot point in as well. That could be helpful. Yeah. So you're thinking, okay, well, look, that means if we get a big miss, I could enter at market. First area to look at moving my stop up to is that R1 pivot point. Ultimate target would be that 0.9150 zone. Okay, so that's how you can go about using it, and you think stops can just be placed above that, below that 0.099050, below the S1 pivot zone. Now, say for instance, price surges up to that 9160 straight away. Where could you look to re-enter? Look, rent on a pullback back to that 9120, then look to take profit 9150, and you could look at stops just underneath the 100 exponential moving average at like 0.9080, or the other side of that S1 pivot zone. So that's how you go about putting things together, okay? And that means oh, okay, heading into the meeting, if there is a big miss, then I know I can go long the Australian dollar CAD. So that's how you go about, putting things together. Okay, that's the way that you manage it. Now, another key data point that we've got coming up is US retail sales. Now, US retail sales is coming up, and this is a bit of a tricky one. All right. But if you notice, the latest set of data from the US, we've been seeing a slowdown in growth, haven't we? Look at the slowdown here. The PMIs in the manufacturing and the services dropping lower, retail sales dropping lower, consumer sentiment dropping lower. Now, the University of Michigan consumer sentiment is important because that's a lot of households that complete that survey. And often a household is far more sensitive to a drop in income than a company. And you think about it, you know, if a household's income goes down, they quite quickly are sensitive to that. And obviously with inflation rising, cost of living rising, it's not a surprise to see the consumer sentiment index from the University of Michigan survey falling sharply lower. So this has got some analysts saying, aha, growth is slowing in the US. What a disaster. And the reason, and some people are saying that's a disaster, is because the Fed's, people are thinking, oh no, the Fed is slowing exactly when they're hiking interest rates aggressively. Now, the Fed's expected, I think, to hike something like 6-7 times this year, according to market expectations, and that seems incredibly aggressive. So if you just look here at the daily chart, do you see this correction? This is the big picture. See this correction we've seen in, see this correction we've seen in the S&P 500 around 12%, right? Now that correction has been on fears that the Fed is hiking too fast. So many analysts are thinking that there's another down leg in stocks. So that means today's retail sales will be viewed in light of this narrative. So if it's a big miss, then that will mean that those fears are stoked that this is a genuine slowdown in growth and that, oh my goodness, the Fed is hiking just as growth is slowing. They're making a policy mistake and they're going to make life hard for companies, hard for individuals. And so future profitability of companies will be hit, and that's why stocks are sold off. You see, that's the narrative. Now, conversely, if retail sales are good, because what some people are saying is, yes, we have this hit in US growth, but it's explainable. It's all to do with the Omicron hit. But today, we have January retail sales, and the Omicron fears had, was starting to recede in January. So that's why today's US retail sales is going to be very important for the big picture. Now, in terms of the market reaction to this, if it's a big miss, look for downside potentially in equities. But remember, at the same time, we've got this other narrative in the background, which is the Russian-Ukraine crisis. So at the moment, the market, there's been like a lot of ping-ponging in terms of headlines. So the news out this morning was that Russia was withdrawing additional troops from Crimea, risk on. But then the NATO Secretary General poured cold water on that, saying yet to see a Russian de-escalation, and so that's risk off. But you got to remember with this that the West are kind of going to play hardball with Russia, and the Russia are like enjoying winding the West up, okay? Because you know what I mean. There's a bit of politics going on and a bit of gamesmanship going on at the moment. So the market's general response is it's expecting Russia to de-escalate. But if it doesn't, I'll show you the pair to trade. So if there's a Russian incursion into Ukraine, the currency pair to trade would be Aussie yen, New Zealand dollar yen downside. Okay. Now I've gone long Aussie yen, New Zealand dollar, Swiss franc because I'm expecting this Russian-Ukraine crisis to fade. Okay. Now I could be wrong, so I've got my stops and I've got my strategy how to get out if things go wrong, right? But I like New Zealand dollar as well because RBNZ are meeting next week, and I'm expecting them to be more hawkish because inflation is at a 30+ year high, and the New Zealand housing market is very hot, and Japanese yen should maintain its funding currency bias for the near term. Let me explain what's going on with the yen. The yen, if you look at bonds, this is the bond yields, okay? Now, basically, when a bond is sold, the yield goes up. When a bond is bought, the yield goes down. So at the moment, people are selling bonds because the yield is unattractive and they're expecting interest rates to rise. So bonds are being sold. Now, the Russian-Ukraine crisis suddenly saw a sudden bid into bonds, right? That's what helped lift gold higher. But what I want to share with you is what's going on with Japan. Now, the Bank of Japan has said that they are happy to keep 10-year bonds, JGBs, in this price bracket between plus 0.25 and minus 0.25. Do you see how the rest of the bond yields around the world? Look, US 10 years, 2, bonds and 0.3 and rising. UK gilts, 1.5, 2% for probably the 2 years. Canada, nearly 2%. Do you see? But Japan has very low yield on its bond. Now, if you just look at the interest rates and if you just look at the inflation expectations, you see, look at Japan's inflation expectations, very, very low. So the fact that the Bank of Japan have just come out and said, look, we want to keep this bond yield where it is, that means that the yen should remain weak for the medium term. That means something like the New Zealand dollar yen at market makes a lot of sense. It's a very attractive buy. Stocks can be placed underneath 74.50, looking for a move back up to 82. Do you see the bond yield spread? Now, do you see how the price tends to track the bond yield spread? Those of you who follow me know a bond yield spread is simply a risk metric for what's going on between two countries. When that spread rises, it means that that country is doing better than the other country. So a New Zealand yield spread advantage as the 10-year bond moves higher. And remember, we're expecting it to move higher. Why? Because the Bank of Japan is keeping it flat, right? So it means this should stay bid. So it means New Zealand dollar yen should stay bid in the near term, which means this should be strong support now on the weekly time frame. So we've got very strong support level. We've got this 76 region, and the buying from market makes sense, looking for a move higher back up towards 82. So that is on the medium term, but there's always a risk. And the risk with this trade is the fact that the yen finds buyers when the market's scared. The yen is a risk-off currency. So when risk is badly hit, people buy the yen. Now, the yen, even when a nuclear bomb was dropped on Japan, the yen gained. Isn't that incredible? So even when Japan itself had a nuclear attack, the yen still gained in value. Why is that? It's because the way the debt is structured in Japan. The way the debt's structured is that every citizen in Japan kind of owns that debt. So it's seen as extremely reliable debt. And that means that it's seen as a safe place to put your money in at times of crises. So the yen gains in worry. So you see here, this was the Omicron concern coming into the end of last year. We saw the yen gain. This is the yen gaining on the Russian-Ukraine crisis, right? Now, if the risk turns positive again, we'd expect the New Zealand dollar yen to be moving significantly higher, okay? So that level looks like a decent support, but the risk is if Russians do make an incursion into Ukraine, this would be a good short. So if Russians do make an actual incursion, that's the currencies to look at. Also, Aussie yen makes sense upside. New Zealand dollar Swiss franc upside makes sense. Aussie Swiss franc makes sense. But if there's a Russian incursion into Ukraine, it's the opposite. You'd be looking at selling. So that's just by way of introduction and to make that clear. Now, so we go through any questions to see if there's any questions that folk have. If you've got any questions, please do ask. Yeah, there's one other thing I want to show you, and this is like so you can get your head around the big picture. But don't make the mistake that some people make a mistake of, and like people make a mistake, like particularly on Twitter, there's something who are permanent bears. They're permanent sellers of stocks. Now, you look at these stocks since 2004. Which way is the chart going? It's going from left to right. Stocks are generally in an uptrend. Okay, so that means buying from support makes enormous sense. Now, with that being said, obviously, if there is a slowdown in growth and the Fed is having to hike to raise inflation, that does make market conditions much more challenging. And I just want to show you something. Let me just. Yeah, right. There we go. You see here. Now, this is the historical S&P 500 corrections. Normally, when the S&P 500 corrects greater than 25%, it results in a US recession. That has been in the last the only time that hasn't been a recession was in 1987. So if we see a correction greater than 25%, you normally see a recession. So that means the level where the Fed is likely to be worried would be if we see, say, like a 25% correction in the S&P 500. So that would mean a 25% correction would take us back down to that 36, 37 band that I've marked on the chart, you see? So if the leg goes that much lower, that's the kind of level where you could expect to find a correction. Do you see? So if prices move that's when the Fed might say, well, actually, we've been too aggressive at rate hike. We might have to pause hiking rates. We're going to try and make conditions better for companies. So just bear that in mind. This is the level that I've got marked. You might want to mark it on your chart. The area where it's not. Now, I'm not saying like the Fed will become concerned at that area, but you see, historically speaking, that's the kind of level you need before you start seeing a recession. And will the Fed want to push the US into recession? Look, of course they won't. Okay, so just bear that in mind. And in terms of medium-term buying, this is talking about, you know, you're holding positions for longer term. That's a great area to look at entering from a medium-term perspective. Don't forget China's 50 index. Again, there's a lot of potential upside here in China. We're still at that support level. There's still a decent opportunity to potentially get in. Last year, we saw nearly 30% falls in China's 50 index. China's 50 is totally different to the rest of the world because the People's Bank of China, they're cutting interest rates, right? And on top of the People's Bank of China cutting interest rates, we're also seeing the fact that the Chinese government is looking at boosting China's growth with a lot of pro-growth policies. So, and a lot of some domestic China brands are really taking on life of their own. I was just looking at a Bloomberg report recently saying like how Nike and Adidas, they lost some of their foothold in the Chinese market, you know, with those US-China trade issues that we had with, you know, President Trump when he was really going to war against China. Well, that boosted quite a lot of home brands in China. So it's meaning that some Chinese brands are starting to, you know, have been seeing some periods of strong growth because, well, it makes sense, doesn't it? Chinese citizens have thought, wow, you know, if we're at war with a trade war, then we'll buy, rather than buying an American company, we'll buy a Chinese trainer company. And that's been boosting some Chinese growth. And that means that risk can be diversified. If China has got its own drivers, then it's a nice area. It'll become more attractive. So People's Bank of China cutting interest rates, progress. You enter that market, stocks below 14,500 makes sense. And even if price moves lower to that 1,400, look at re-entering again with stocks underneath 13,300. Just underneath 13,250. So they're two areas that I am long personally, China's 50 index. And I've also got some longs which I'm holding, looked for 3, 4, 5 years. Over the next like 10 years, China's expected to, you know, outgrow US in terms of the world's #1 GDP. So China is making a move to be the world's leading economy. So from a medium-term perspective, investing in China could make a lot of sense. Now, of course, there's risks. The risks are that doesn't materialize. The risk is China becomes very inward looking. The risk is that Chinese socialist government has a total, rejig in how society works, and some of the moves towards free market capitalism are unwound. So there's always risks, but I just wanted to point that out. That it's and when that key support level, so it still is a nice area to potentially go along. Now, with all that being said, Eddie's asked a question. Thank you, Eddie. What's your take on gold? Let me explain what's going on with gold. Right now, I put an article out on this. What would, if there is a Russian incursion of Ukraine, gold's to gain. Now, this is my blog. Come along here, look at my central banks. Make sure you're following my blog, because I put loads and loads of good material up here, right? So one market I was looking at was gold if Russia made an incursion in Ukraine. Now you can see that gold was gaining on a potential Russian incursion into Ukraine. Now, why is that? Now, understanding this is complex, yeah, but it's important. Now, if you noticed, do you see these 10-year yields? Do you see how, right, do you see how on Friday 10-year yields tanked lower? That was on the news that Russia was making, an incursion into Ukraine and due to invade Ukraine. Now remember, this is a treasury, so that is the yield falling, is that treasuries being bought. Why? Because in a risk market, people want to buy US treasuries. It's seen as one of the safest investments in the world. So if we just overlay US 10-year here, again, I'm using financial source charts here just to do it, because I've got to do all my analysis on these charts now. Let's have a look. All right. Right. Do you see how the 10-year yields move lower and that brought gold higher? Okay. Now let me explain what's going on here. Now, if you look at this chart here, this is the chart that you need to understand what's going on with gold, and it's the only chart you really need. Right? I've got three things on here. I'm going to take gold off. I've got TIPS, which I'm using as a real yield proxy. Now, the reason I use TIPS as a real yield proxy is because real yields are only updated once a day, but TIPS is updated intraday in the US session. So, in other words, I'll get a bit of movement on this. Now, what you want to see is when you see like real yields moving lower at the same time the dollar's moving lower, that's when you see gold upside. So you see here, real yields moving lower, dollar moving lower, you see gold upside. So first of all, what is a TIPS? Now all that is a US 10-year yield minus inflation expectations. Now we all know inflation expectations have been really high, okay? But recently, the expectations for the Fed being more hawkish has been boosting 10-year yields quicker than inflation expectations have been moving. So that means that real yields have been moving up. Now, when those 10-year yields were bid, we saw real yields fall. So falling real yields tends to be a positive for gold, okay? Now, the dollar was not moving in line. So even though real yields were falling, the dollar was rising. So that meant just a little bit of upside in gold. But when you see these two moving together, that's when you see the best opportunity in gold, Eddie. Okay? So do you see here? You see in November, when real yields and the dollar moved lower, gold soared. In April 2021, gold soared. In June 2020, right now, if I put gold over the top, you see falling real yields, falling dollar, rising gold, falling real yields, falling dollar, rising gold, falling real yields, falling dollar, rising gold. At the moment, gold's mixed, right? And the reason gold has just been rising recently is because of that fall in real yields. But remember, if Russia don't make an incursion into Ukraine, then yields might start rising, Eddie. And if yields start rising again, then that's a pressure on gold to the downside. But at the moment, do you see how the dollar and real yields have been moving weirdly? Now, what does that tell you, Eddie? It tells me the market's biased towards buying gold. Because even though real yields are rising And even though the dollar's been falling, gold has still been rising. Okay, so the market is very bullish gold. Now, is this easily tradable? No. What's the trade? The trade is as follows. If we see, say there's a news, Russia make a move into Ukraine, right? Then expect gold to surge. The reason gold has been dropping is because the news that Russia's pulling back, right? So that means that real yields can start to rise again, which means gold falls. Okay, so remember that's what we saw here expressed on this chart. You see that? You see that fall, that rise in real yields? Real yields rising, gold falling, right? So that's what's going on now, and it's going on that headline that Russia's withdrawing troops from Crimea. So what's the trade, Eddie? Right, let me explain to you. Here's the trade. One, if Russia move into Ukraine, buy gold at market, looking for taking profit in 1900 and looking to hold, right? Because you expect more bids into bonds, and that should drag the yields in the right direction. The other way is you might say to yourself, well, gosh, you know what? I'm really, I think this is a very bullish market, because I think if even though the dollar's rising and with real yields where they are, gold's still moving higher, I think gold's worth buying. So technically, there is a nice area where you can define a limit risk, which will be buying at market with stops, I would say just underneath that 1820 region, looking for a move back up towards 1900 and 1950. That makes sense to me. I personally won't take it, Eddie, because of the reason I've shown you. I want to see the dollar and real yields going in the right direction, okay? But technically, this is noteworthy. We've got a break of this trend line, tested the trend line, tested the trend line. Part of me would favor buyers. So right now, I would favor sellers. I'm expecting sellers to take price back into 1830, okay? That would make sense to me, but I'm just acknowledging this key trend line. And I'm also recognizing that gold has been really quite robust despite the move higher in real yields. Does that make sense? Eddie, does that make sense to you? Eddie, let me know if that makes sense or something is still not sure. Okay. All right. Okay, great. Okay, Eddie's gone. Okay, folks. I hope that's clear. Now, remember what to be looking for today. Canadian CPI data coming up. We're looking for US retail sales. We're then looking at Russian-Ukraine crisis. The best opportunity that I'm seeing right now, from a medium-term perspective, is New Zealand dollar yen, New Zealand dollar Swiss franc stops just underneath those recent swing points. Makes sense to me. I think risk can be defined very nicely, and I think the opportunity for upside is really quite nice. Folks, take care, and don't forget, I am scheduled to be back here on Monday. And in the meantime, don't forget, check out my blog, check out my Twitter handle as well. I'm at Giles Cochran CCA. You can follow me there. And also, I try to put up some interesting posts. And also, don't forget to follow me on my blog here at HYCM Lab. This is my own blog, and sort of 95% of the stuff on here is stuff that I've written. Folks, it's been a pleasure as always. I hope you take care. I hope you have a really good trading week. And I look forward to seeing some of you guys on Monday again. Thanks everyone now. Goodbye.